Hi class, our discussion for this video will focus on the 5 major accounts. The objective for this is for you to familiarize what are the account titles under the 5 major accounts. We have the assets, liabilities, capital, and income expenses. So these 5 major accounts is presented in one of the financial statements in balance sheet and income statement. So what to expect? At the end of the discussions, you can define, identify, and classify accounts according to the 5 major types. Before we start with the discussions for the 5 major types, let me present to you the accounting cycle. This will be our guide for the first semester. So at the end of the semester, you will be able to identify the accounting cycle. First, identify and analyze transactions, record transactions to journal, post journal information to ledger, prepare and adjust the trial balance, adjusting entries, prepare and adjust the trial balance. You will also learn to prepare financial statements, closing entries, and prepare post-closing entries. So we'll skip the reversing entries. Again, what are the 5 major accounts? If you can still remember what I just said a while ago. So we have the assets, liabilities, capital, income, and expenses. Okay, for the first account, we have assets. This is presented in the balance sheet or statement of financial position. So for assets, we have current assets and non-current assets. Now, I want you to memorize the 5 major types and also which account is under assets and non-current assets, example, and its normal balance. And once you will be able to memorize all of these accounts, it is easy for you to identify and analyze the transaction and to make journal entries. So for current assets and non-current assets, okay, let us define first the current asset. It is expected to be realized within accounting period or 1 year. And for non-current assets, this is a long-term investment held by enterprise, usually for more than 1 year. And to add also for current assets, within 12 months, and also the account titles under current assets, the company consider those assets under current because they held it for trading. For current assets, we have cash. I think we already know what is cash all about. For companies end, usually have cash in hand and cash in bank. Cash equivalents, this is a short-term investment that is convertible into cash within short period of time. While marketable securities also, these are stocks and bonds purchased by enterprise. Also convertible into cash within accounting cycle. To add in cash equivalents, this is subject to insignificant risk to changes in value. Next, we have trade and other receivables. For trade and other receivable, we have account receivable. This is collectible to the customers. So example, customer purchase an item to us, credit. Note receivable, collectible still to the customer. However, the customer promised to pay a specific period of time. Interest receivable, amount of interest collectible on promissory note. Advances to employees, this is loan by employees subject to salary deduction. Accrued income, these are services that we already rendered to the customers but not yet received the payment. So these are the account titles usually under current assets. By the way, the assets content will still depend on the availability of the assets of the company. So what are the available assets? That is the only account titles that you will be reporting on their financial statement. For current assets, as what we have discussed a while ago, we also have contra assets. What are these contra assets? It means opposite to the normal balance of assets from the word contra. So for allowance for bad debts, this is the loss or losses due to uncollectible accounts. So example of this, customer was not able to pay, like for example, his obligation amounting to 100,000 and he only paid like 95,000. So we have losses. So we consider that as allowance for bad debts. And even for the whole period, like for example, the total account receivable is 1 million. But then of course, we will not expect that we will be able to collect the 1 million. So we always have to consider the losses, and we will write it under the allowance for bad debts. Again, the allowance for bad debts is deducted under account receivable, since this is open obligation of the customer. This is the sample of the computation for account receivable. Example, 100,000 and the allowance for bad debt is expected to be 5%. So what is 5% of 100,000? 5,000. And the account receivable net will be 9. Let's proceed now to non-current assets. This is usually held by business for long-term investment. So what are these accounts? What are the account titles under non-current assets? We have property, plant, and equipment. For property, plant, and equipment, we have land, building. Example of equipment, typewriter, air conditioner, computer, trucks, and cars. Example also for furniture, tables, chairs, sala set. Those are example of furniture. So these assets under non-current, the company acquired these assets and for long-term investment. And also, they are using these assets for their trading, in providing services, and also whatever the type of business. And some also of the investment, like for example for land, there are instances that they purchase it and not using the asset. For intangible assets, we have non-monetary assets. That means without physical substance. Example of these, goodwill, patents, copyrights, trademarks. For non-current assets, we also have contra assets. We call it depreciation or accumulated depreciation. So it represents expired cost of property, plant, and equipment. Now, maybe you will ask, why not land? Usually, land will increase the value as the time passes by, except if the land is prone to landslide area or typhoon. So that's the time that the value of the land will decrease. But that is very seldom. So for the accumulated depreciation, the represent expired value of the assets under property, plant, and equipment. So we have here an example for building 1 million pesos, and the building life is 20 years. So how to compute depreciation? We have a lot of methods in computing the depreciation of the equipment, but the easiest method is straight line. So straight line method, we just have to compute using the amount or cost of the building. Example, 1 million, divided it to 20 years, so will come up 50,000 per year. That means that the building value will depreciate 50,000 every year. So for the first year, the depreciation expense will be 50,000. So the value of the building for first year will be 950,000, or at the end of accounting cycle for first year will be 950,000. For liabilities, we have current liabilities and non-current liabilities. For current liabilities, this is expected to be settled in the normal operating cycle. So these are classified. The classifications: accounts payable. This is a payable or obligation that we owe, but we do not know yet when we will be paying. While notes payable, we have written promissory note on when we will be paying this obligation. For loan payable, this is our obligation to the bank. While utilities payable, these are the bills that we receive, like from PLDT, Water District, or Davao Light that we. So this is our still outstanding obligation. We use the account title utilities payable. For unearned revenue, this is also our obligation because the customer made an advance payment. However, we are still owed to our customer to provide service. So we write unearned revenue. For accrued liabilities, these are incurred expenses but not yet paid. So we call it accrued liabilities. Non-current liabilities, these are the long-term obligation of the business. So example of long-term liabilities of the business is mortgage payable. So papers that usually we can collateral is the land title. Next is bonds payable. This is also long-term obligations like 3, 5, 10 years. Depends on the agreement. This is a certificate of indebtedness under a seal of a corporation. So example, usually public utilities issue bonds to help finance a new electric power plant, or hospitals issue bonds for new buildings, or the governments issue bonds to finance projects, operating deficits, or to redeem older bonds that are maturing. So those are the example of bonds payable. For accrued liabilities, if the obligation is long-term, more than 1 year, so again, these are the expenses that we incurred but not yet paid. But usually, accrued liabilities is under current liabilities. For the owner's equity account, we have capital, drawing, income summary, income or loss for the period. So capital, this is an account bearing the name of the owner. So here initial investment or the total investment of the year. For drawing, these are the personal withdrawal of the owner for personal use. So we write it under drawing or withdrawal account. But the proper account title to be used is drawing. For income summary, this is a temporary account we usually use at the end of the accounting period when we are closing the nominal accounts. So But then the income summary will be transferred to capital. There will be another discussion for closing nominal. Income close for the year. This is the result of the operation of the business. So when we will see if the business is earning or losing. So example, at the end of accounting period, we prepare income statement for the year. We will have the result if how much the company is earned for the period or lost. So these are the account titles under owner's equity. Please memorize and familiarize so we may have our next lesson for journal entries, so you know already what the account title to use. Now, please take screenshot of this and try to answer in your journal notebook. Thank you so much for watching this video lesson. I hope you learned from our discussion today. So again, this discussion is about the major accounts, which is very important for our next lesson, which we will be having our journal entries. Please do memorize the account titles under assets, liabilities, and owner's equity, as well as its normal balance. Thank you so much, and please don't forget to subscribe to be updated for our next video lesson.